Hi everyone, welcome to my finance lab. In today's video, we'll dive into building a Markowitz portfolio with two stocks using Excel. By the end of this tutorial, you'll understand how to calculate the efficient frontier, optimal risky portfolio, and the optimal complete portfolio. You will also learn how to plot these. Before we start, we need historical returns for two stocks. For this tutorial, I'll use Stock 1 and Stock 2. You can download data from Yahoo Finance, Google Finance, DataStream, or any other reliable source. To find the optimal risky portfolio, we need to identify the portfolio with the highest Sharpe ratio. That's why the first step is to create several different portfolios with varying weights in Stock 1 and Stock 2. The sum of both stocks must always be equal to 100%. Now let's start with the weights for Stock 1. Our first weight will be 130%. The following weights are calculated by subtracting 10% from the previous weight, starting with 130%. For Stock 2, we use the property that the portfolio is 100% in total. Therefore, we can calculate the weight of Stock 2 as 1 minus the weight of Stock 1. Next, we calculate the portfolio returns for each weight combination. We calculate the portfolio return as the sum of weight 1 times mean return Stock 1 plus weight 2 times mean return of Stock 2. Make sure to lock the mean returns with F4 or the dollar signs. Then we compute the standard deviation for each portfolio. The standard deviation of a portfolio is the square root of weight 1 squared times variance 1 plus weight 2 squared times variance 2 plus 2 times weight 1 times weight 2 times the covariance of Stock 1 and Stock 2. Also, make sure to lock the variances and the covariance. With the portfolio returns and the standard deviations, we can calculate the Sharpe ratio as the excess returns divided by the portfolio standard deviation. Then with our portfolio returns and standard deviations, we can plot the efficient frontier. Go to Insert, select Scatter Plot, and then we will fill this with some data. On the x-axis is always the standard deviation as a measure of risk. On the y-axis are the portfolio returns. To get the efficient frontier, we select a solid line to connect the dots. Let's insert the capital allocation line. On the capital allocation line are all possible combinations of a portfolio consisting of an investment in the risk-free rate and the optimal risky portfolio. Although see Tobin separation theorem. I highlighted the optimal risky portfolio in yellow. This portfolio has the highest Sharpe ratio and therefore the steepest capital allocation line because the Sharpe ratio is the slope of the line. We need to calculate just 3 points on the capital allocation line to plot it. The first point is in 100% investment in the risk-free rate. The second point, a 100% investment in the optimal risky portfolio. And the last point is a 200% investment in the optimal risky portfolio. Therefore, the investor borrows at the risk-free rate to invest more than 100% in the risky portfolio. After determining the optimal risky portfolio, we are also interested in the optimal complete portfolio. This depends on the preferences of the investor. We will use the Excel solver to maximize the utility function of the investor. We start with a 50% investment in the optimal risky portfolio and 50% in the risk-free rate. We need the sum of the weights as a formula because this will be a constraint for the solver. Then we just fill in the data in the table. The portfolio return is, as always, just the weighted average of the portfolio returns, but the standard deviation is just the weight in the optimal risky portfolio times the standard deviation of the optimal risky portfolio because the standard deviation of the risk-free rate is 0%. With this data, we can compute the Sharpe ratio as the excess return, so just the portfolio return minus the risk-free return divided by the portfolio standard deviation. As you can see, the Sharpe ratio does not change. Now we compute the utility for this investor. A is the level of risk aversion, typically between 1 and 10. I will use 5 for this tutorial. Now we go to Data and select the solver on the right. We want to maximize the utility, and the weights are allowed to be changed by the solver. As a constraint, we want the sum of the weights be equal to 1 or 100%. If you leave the checkbox below, we are not short selling. If you want to allow shorting, just put the checkbox away. Click on Solve, and the solver will maximize the utility by changing the weights of the investments. With this maximized utility, we can just solve the utility function for the expected portfolio return to get values for the indifference curve. We have to select a few standard deviations, and with them and the utility, we compute the portfolio return. After this, we plot these values to get our indifference curve. On the indifference curve are all combinations of return and standard deviation that give the investor the same level of utility. We can observe that the optimal complete portfolio is the tangency point on the capital allocation line with the indifference curve. Thanks for watching. Leave a like if this video could help you, and also write a comment on what topic I should do the next tutorial.